Welcome to the Money Pig Podcast, presented by Goodwin Investment Advisory, where our mission is to lead you to financial pig, peace, independence, and generosity. I'm your host, Tim Goodwin.
Well, we are super excited to have Justin Pitcock, the one and only Elmer Fudd, with us today. How you doing, Justin?
I'm hanging in there. Little congested, but I'm doing okay.
And this is where the power of web video conference call keeps us together, but we're not sharing terms. So I appreciate you even just being willing to jump on today. And we're going to be talking over our year-end planning checklist, which we do in partnership with an estate attorney we work closely with, Sarah White, and a CPA firm we work closely with, Pantana. And so we put this end-of-the-year checklist together every year, and we update it. And so we just thought it'd be really helpful for the audience for me to bring you on today, Justin, and to talk through some of the lists. We're not going to give it all away. That could take too long, but it is kind of graphically appealing. I can kind of show it here if you're watching. So it's not too bad. Nice big check circles here. You can download it in the show notes to get the full thing. But I don't know if I was telling you about this, Justin, earlier, but I don't know if you heard that apparently you cannot use beef stew as a password.
Really? Why is that?
Yeah, it's not strong enough.
It's a good dad joke.
Yeah, got to get that dad joke out of the way. So, well, hey, before we jump into this, Justin, tell the folks listening, something they don't know about you, something interesting about you.
Oh man, I don't know. I think most of my clients at least know I'm an avid outdoorsman. Love to hunt and fish. I've got 2 boys. The oldest is 6. The youngest is turning 2 tomorrow.
Oh, dang. Mark Wade's birthday tomorrow, huh?
That's right.
That's awesome. And you actually, speaking of hunting, you went duck hunting, I think, this past weekend, right?
I did. Yeah. We went, duck hunting. Duck hunting's like, it's so much fun because it's a community, like a group hunt. And, you don't have to sit sit somewhere still for hours and be completely quiet. Like you actually get to be with your friends and you can chat a little bit. And
kind of keep moving. Did you guys have any dogs with you?
We did. Yeah. One of my buddies has a lab that retrieves, and it's super helpful when you're duck hunting. I mean, you don't have to go out.
Awesome.
You don't have to go out in the cold water. And then if you can't find it, that dog's got an amazing nose and can,
sniff it out.
You'll be able to find it. That's right.
That's awesome. So I heard you guys had a successful trip. So that's great. All right. Well, let's jump right into this year-end planning checklist here that I've got held up. The first one right here, we've got a couple of different categories under estate and disability planning, retirement planning, investment planning, and tax planning. So the first one under estate and disability planning is review estate planning documents, wills, trusts, power of attorney, healthcare directive to ensure decisions are compatible with your wishes. Tell us why that's important.
Well, I mean, obviously, if you've had a life event, you don't want to, leave a child or family member out of your estate plan, or, if there's a big event, getting married, or unfortunately, like someone going through a divorce, obviously you need to make sure that those documents are all up to date. And keeping that in order is a way that you really show your loved ones that you care about them versus leaving a mess for them to deal with when you go. So.
Absolutely. I think it gives people a lot of peace of mind too. A lot of times you meet with clients and everybody's like, yeah, I know I need to get a will or I need to update it. They're always kind of thinking about, I should. And it's nice when it's finally done. We like to reward the behavior we want repeated around here. So we do incentivize our clients to do it and give us a copy. Lets us know that they've got it buttoned up. We keep an electronic version. Next one here, check beneficiary designations on financial accounts and life insurance policies. Why is that important? Also relates to something you just said.
Yeah, exactly. I mean, when you list a beneficiary on an account, it transfers via what's called via contract versus through probate. So you want to make sure that you've got a beneficiary on all of your retirement accounts for sure. Non-retirement accounts, it may depend on your exact estate plan, but in general, we do not list beneficiaries on non-retirement accounts. But ultimately, you want to make sure that money's going to the people that you want it to, and that's coordinated with the rest of your estate plan.
Yeah, I think one way to say it is like your beneficiary supersede your will. So they're like, well, I updated my will and, I'm divorced now and all my money's going to my kids, but you still have your ex-wife on your 401k, your ex-wife on your life insurance, your ex-wife on your IRA. It's going to go to her. It's going to supersede the will. So it's very important to keep it up to date. Yeah. And having that beneficiary keeps it in that kind of tax advantage account, right? Lets that beneficiary have some options on pulling that money out over time and looking at tax strategies. Sometimes without having the beneficiary on there can lead to a lot of tax issues if they've got to take it all out at once.
From retirement accounts, that's right. Because if a retirement account's left to your estate, it has different withdrawal rules than if it were left to a beneficiary, to a real person.
Yeah, so I'm glad you shared like our general rule of thumb at Goodwin Investment Advisory is to have a beneficiary established on any retirement account and to make sure that that's up to date. When we do our annual meetings with our clients, we always review the beneficiaries in case things need to be updated. Little extra bit of advice here. When you establish a beneficiary, there's often a little box at the bottom. It says per stirpes, and it's a Latin word that means by branch. And so, for example, my wife, I had that box checked because it's going to follow her bloodline. If I outlive her and I don't update her, and it's going to follow through to her kids equally, which are my kids. So it just saves me from having to, also have all the contingents set up. So that it's not always what everybody wants to do. But that is what that box means. It's by branch. It's follow the bloodline of that designated beneficiary if they're no longer living.
That's an important thing to know too, because you can have it go by branch or by name, basically.
Right.
But if your spouse was previously married and has kids, outside of your current marriage, it would go to her kids. But if you've got kids from a different marriage, you could disinherit your own children that are from a different marriage. So that's, that's something that you have to, keep in mind when you're checking that box.
Yeah. Very important. And, as advisors, we help people try to understand what the options are and let them decide what's best for them or work with an estate attorney. You're going to hear this big disclosure at the end of the podcast, every episode that talks about, we are not estate attorneys. We're not certified public accountants. We are CFPs, certified financial planners. And so it is best to double check with your advisors, with your estate attorneys to best understand your options. But we're trying to just educate folks here. So the next item here, Justin, that I want to talk about under estate and disability planning, prepare and review a list of instructions, assets, liabilities, contact info, et cetera, for loved ones in the event of your death or disability. Why is that important?
Man, that's such a gift. If something happened to you, would your wife know where to find your life insurance policy? Or
even just the number of your life insurance agent, right? What their name is. What's the company? How do I get in touch with them?
Yeah. Yep. So just having all that stuff in order is very helpful. But we'll say for all of our clients, we like to build out their plan in our planning software. And we have the opportunity to list, the life insurance, all of the accounts. You can enter in the financial institution, account numbers if you want. But it gives you a complete list of all things financial so that if something did happen to you, your spouse would know, okay, talk to Justin, talk to Tim. We'd go to our planning software. It's like, okay, this is where the life insurance is. This is where all the accounts are because we've got your financial plan up to date in our software.
Yeah. And I remember, I think I heard Dave Ramsey say it first, this is a way of like saying, I love you to your heirs. It's like an I love you letter. Like you've got this whole thing buttoned up. It's super clean. It's not a disaster. There's some documents and some clear instructions. I do an annual financial planning meeting with my wife every year. I mean, I'm a financial advisor. I feel like I should be, taking advantage of those services for my own family too. And it's something that I just kind of force my wife to sit down and say, hey, here's where the assets, the liabilities are. Here's the insurance policies. You just want to make sure that she's aware of them and what the plan is. And that kind of leads into this next point, Justin, that I want us to talk about, which is talk to your loved ones about their roles in the event of your death or disability. If you've got folks named as executors, executress, successors, trustees, guardians, you need to make sure, or, beneficiaries for all that matter, it's important to not surprise people after you've died. It's much better to communicate, just like any relationship we have. It's going to be better with better communication.
Oh yeah. If you're, putting someone else in charge of your kids, they should probably know that before that happens.
Yeah. Yeah. Surprise, surprise. You got some more kids coming at you.
Get some more mouths to feed.
Yeah. Yeah. All right. So the last one on this section, Justin, I'll hand it over to you. This idea about maybe giving an early inheritance and that you can give up to $18,000 per person without needing to file a gift tax return. What does that mean?
So, there's a lifetime exclusion, and it's been bumped up every year. It's indexed for inflation. Under the current tax code, it's almost 14 million per individual.
Wow.
So when most people don't have to worry about this.
Right. Shucks. Well, I wish we had to worry about it though.
Exactly. But when you give over 18,000 per year, that additional dollar amount reduces your lifetime exclusion. And if you did have if you gave away or you had an estate over that 14 million, that's per individual. So it's double that for a couple. But if you had wealth over that point, then you would pay estate taxes. Now, this 18,000 is just the number that you're able to give to each individual every year without having to report that gift to the IRS. And it's okay if you want to give more than 18,000. You just have to file a form. I think it's Form 709. I might be making that up, but I'm pretty sure that's it. You would include that with your tax return. It's just a notice filing that you've given one individual more than 18,000 in that particular year. So if you give less than that, you don't even have to report it.
Yeah, you know what I think is really interesting too is it says per person. And I think whenever I hear that, for some reason, my brain says per family member. And then I even think it's just my family, right? But the reality is it's not family, it's per person. I mean, you can give your kids each 18,000. If they're married, you can give each of them 18,000. And then your spouse can do the same thing. It can add up really quickly. But the reality is it's not limited to just your directly related family or your family-in-law. It's anybody that you can give. It is Form 709, Justin. I looked that up, that you would have to file if you give over 18,000. Good job.
It's also for clients who may be dealing with that estate tax threshold. They can try to get more money out of their estate earlier on. And if they can pass it on to kin or their beneficiaries earlier in life, over the next 10, 20, 30 years, that growth is in their beneficiary's name and not in their name. So part of the strategy for a lot of our clients is to go ahead and every year start giving money to the people that they would otherwise, when they go, that they would want that money to go to anyway. But they're trying to get that out of their estate early so that all the growth that compounds on that over decades is compounding in their beneficiaries' name versus their name.
Absolutely. Absolutely. And I know you're not feeling 100%. It did say the lifetime exclusion is 12.92 for this year. So closer to 13, maybe not 14.
I think for next year, it's like 13.99.
Oh, you're saying what next year in 2024? What's the lifetime for 25? It's crazy, man. And it's cool because that works per couple, right? So, if it's 13 this year and you're married, it's 26. You're right. So it's 13 and 24 and it's 14, almost 14. 13.99 and 25. So that's pretty impressive. All right. Well, let's, for the sake of time, let's keep moving. That's some great food for thought on estate planning. Let's jump into retirement planning. Overall, we feel like it's just a really great idea to circle back on your 401k. If you're employed and you're contributing and you're not maxing it out, see if you can just increase it 1% a year until you do, until you hit that limit. I think that can make a huge, huge difference. And if possible, look at your traditional Roth IRAs, see if you can contribute more, possibly max those out. Ultimately, the goal of a financial advisor is to check on those tax advantage accounts that our clients have and to make sure they're participating in those as much as possible. That usually makes sense. That's typical kind of rule of thumb advice for folks. Justin, any comments on maxing out 401k, traditional or Roth IRAs?
Yeah, something that's new that I think is for the very first time going into effect next year, 2025. If you're age 60 to 63, you can put in the normal 401k contribution plus an additional 11,250.
Yeah.
So now that's different. Anybody that's 50 and wiser, you've been allowed to do what's called a catch-up contribution. And that's 7,500 next year. But if you're 60 to 63, you get to do a little bit extra. And so that's a new little catch-up contribution that goes into effect next year. We've never had that before. So that's pretty cool.
Yeah, this is why you need an advisor, Justin, because they are changing the laws all the time and we can barely keep up with them ourselves. But yeah, so if you're between the ages of 60 and 63, you've got the max, you've got the catch-up, and then you've got this extra...
The additional catch-up.
The extra catch-up.
That's right.
It's crazy. So, all right. So let's talk about, let's see here. Yep. Make sure that you're, maxing out all these things. There are these income limits I wanted to make sure I mentioned as far as, where you can no longer be putting into 401ks past a certain amount. With IRAs, they just will eventually phase you out of any contributions. So that's wild. Yeah, pretty cool. But something you got to look at. Evaluate the merit of Roth conversions. Tell us about Roth conversions.
Well, so Roth conversions can be a good strategy for some, but it's a lot of times not a good strategy for others. So it really depends on your very unique situation, your income at the time, your retirement plans. It depends a lot on Social Security. And so in the past, the main benefit of doing Roth conversions earlier in life was so that you could avoid taxation on your Social Security. So let me explain how this works. Your Social Security income can be taxed or tax-free. It depends on how much other non-Social Security income you have that is taxable. So that's called your provisional income. And when you convert money to Roth and you're in retirement and you're drawing Social Security, Roth withdrawals do not count towards your provisional income. In other words, you get this tax-free money coming from a Roth, which allows you to receive your Social Security tax-free. So in the past, when we evaluate, the merits of a Roth conversion, it has to do with, can we convert enough so that you can receive your Social Security tax-free? And that's generally the strategy, and that's the main, or one of the main deciding factors. There's other reasons to do Roth conversions too, but this is, by the numbers, this is one of the main things. Right now, I'm kind of wondering what will happen with Social Security, because President-elect Trump is saying that he'll end taxation on Social Security. So if nobody has to pay tax on their Social Security, that's going to put in question the value of Roth conversions. Now, there's other reasons to do it, like leaving a tax-free inheritance. That's not so much by the numbers, unless we're kind of going to make assumptions based on the tax rate of your heirs versus, your tax rate. But so point being, there's maybe other reasons to think about Roth conversions, but based on your lifetime, the main thing has been whether or not we could avoid taxation on your Social Security. Yeah.
Just to be clear, when you convert money into Roth, you are paying taxes. Justin's saying just over the lifetime value of all the taxes you're paying, it could save you taxes long term, depending on how Social Security is taxed, depending on how it reduces your required minimum distribution for your tax deferred IRAs. We ultimately don't want our clients to be paying in the highest tax bracket in their retirement years, in their 70s and 80s. So it's things that we look at. I think the concept of converting from a tax deferred IRA to a tax free IRA isn't necessarily that difficult to wrap your brain around, but it gets complex when you start to think about all the considerations that have to come into play. So it is definitely something we highly recommend you talk to a financial professional about, and to consider all the tax implications, the withholdings, making sure you've got enough money to pay the taxes. And there could be some law changes coming in the future. A conversion is certain. You being able to save net taxes in the future is not certain. So certainly something that can be powerful for some folks and maybe more risky for others. So thanks for explaining that, Justin. For the sake of time, we're going to move on to the investment planning section of our year-end planning checklist. So right here, schedule a meeting with your advisor to discuss your accounts and distribution strategy, if applicable, and if you need to adjust your risk tolerance. Tell us about that.
Well, so for our clients, we're going to make rebalances to our clients' investment account, or to their strategy a couple times a year. So we're kind of realigning that risk tolerance. But I think this is a good opportunity to think through: do you have new goals, or has your time horizon changed? Are you fed up with work? Do you think you're going to retire sooner than you anticipated? So those are reasons why we would change our risk tolerance, our how aggressive or conservative we are. But for our clients, we're going to be kind of rebalancing periodically, anyways. So I don't know
That's
if you
true.
have anything to add
Well,
to
just
that.
yeah. I mean, if you've got an advisor that's not us and you haven't met with them, you need to meet with them and talk about it. And if you don't have an advisor, you're doing this yourself. I think it's just very important to double check that the risk tolerance you have, the asset allocation of stocks to bonds, is appropriate for your time horizon and for your goals and for your appetite for risk. And while you're doing that, look at rebalancing the portfolio. And if you have any concentrated stock positions, a lot of times we say around here that concentration makes you rich and diversification keeps you rich. So a lot of times clients will hire us with substantial positions in individual stocks. We almost always recommend they start diversifying that, selling that over time. There'll be tax implications and strategies because it's just very, very hard to keep all your risks into one company. And so double checking on your concentrated portfolios. Justin, what positions, what would you define as a concentrated position? Like what percent of your investable assets is concentrated?
10%.
Yeah. So 10% or more of your investable assets in one stock, we would consider concentrated, right?
That's right. Yep.
Yeah.
And, it's, I've actually had a couple clients recently that have had some concentrated positions, and it's like, no, I don't want to sell, realizing cap gains. And, it's a great stock, but gosh, even a company that you think is great and will not, won't take a big hit. I mean, it can happen. And actually I've one of these clients recently, refused to, want to sell their stock, and it was United Healthcare, and the CEO was recently assassinated, and that stock has taken a hit, big. I mean, it's declined big time, and so my clients sitting here didn't want to sell it, and now they're asking, well, should I sell it? Well, should have sold it when it was over 10% of your.
At least trimmed it down to that. It's hard because we all a lot of us think about Enron. We're like, oh man, I can't believe that happened, and these employees that were there, Enron employees would put so much, if not all, their 401k in Enron stock. And you think, oh, they shouldn't have done that. But think about them in that, like, if you were that employee, you didn't know that Enron was going to fall apart, and they're there outperforming the market every year. I mean, Enron consistently outperformed the S&P 500, and you work there. So you got, like, I work here. I understand. We're going to keep kicking butt and taking names. I'm just going to go all in on Enron. Well, Enron becomes an accounting fraud nightmare, and you don't have a job and you don't have any assets. And so we just feel like the risk is too great to concentrate. So I'm glad we got to spend some time on that. Rebalance your portfolios. We've been riding a little over 2-year bull market at the point of us filming this pod. That probably means your equities have greatly outperformed your fixed income. If you're not a fully aggressive investor, you really need to consider trimming that stock down, because you're going to start moving more and more towards an aggressive allocation if you're not constantly rebalancing your portfolio. We're not saying chop the legs off from those great stocks and investments that are running. It's just important to kind of trim them back a little bit. because there's always pullbacks. We always talk about that's the price you pay to be a stock market investor and get these great returns. The price you pay is the volatility. And if you don't want that volatility to hit you as much, you really got to have more fixed income in there. Justin, as we wrap up the investment planning section here, maybe mention a little bit about capital gains and carry forward losses.
So cap gains, it kind of goes in line with rebalancing and being that we're 2 years into a really substantial bull market run. And you've probably got a lot of cap gains in your portfolio. And so if you realize a substantial amount of gains, it's best practice to make quarterly estimated payments. That's something that we talk to our clients about. And, we'd love to get your CPA involved, make sure that we're making proper estimated payments because we don't want you to get hit with penalty and interest. So
that's great. Very important when you're making those trades in non-retirement accounts to be aware of you're realizing long-term gains, short-term gains. You have losses to offset those, carry forward losses from before, and the estimated payments. Very important.
Yeah, the loss carry forward, which I know some folks may have a loss carry forward, for example, from like 2022, and you might be able to use some of those losses to rein back, to realize some gains after 2023 and 2024. And if you have a loss carry forward, you might be able to kind of rebalance your portfolio and actually not owe any tax. So I know
that's true.
There's
something your CPA would know about with your tax return. Last thing on investment planning, just look at those returns that you got for every year at the end of the year and go, is that enough return to meet my goals? Is that enough return to meet my goals? If it's way above the return you need to meet your goals, you might just want to double check that allocation, that rebalance, and that concentrated exposure so you're not dealing with too much risk. All right, we're going to bring it home here, Justin. Really impressed for the folks that are still listening at this point through our year-end checklist. These folks are after wisdom and like to dot I's and cross T's. So my hat's off to you if you're still listening. So we want to make sure that you are taking full advantage of your matches from your employer. We mentioned the 401k before, but there's also the FSA, the HSA. Justin, maybe mention why there's some kind of tax advantages, maybe specifically on the HSA there.
Oh yeah, we love the HSA. It's got a triple tax advantage. So you avoid income tax, you avoid payroll tax, and if you invested, it grows tax free. Now, an HSA, like obviously, you've got to use that for healthcare. But after, oh gosh, I'm blanking on the age. Is it 65 or?
I think so. It's older than I want it to be. I think it's 65. I'll double check while you talk about it.
I think it's 65. You can use it for non-medical if you want, but you have to pay income tax on the gains. You have to pay income tax on all the distributions because you get a deduction when you put money in. So ideally, you do use it for medical, and from the time you open the HSA, or if you had multiple HSAs, the time you were first eligible and while you were eligible to contribute, save all of those receipts because 10, 15 years could go by and you can actually reimburse yourself tax-free for any medical expense that you've had from the time that you were eligible to contribute to that HSA. So that's something that a lot of people don't know about. But if you think about, well, if I stock away, if I max this thing out every year for 15 years and go into retirement, it could be a decent tax-free account to pull out of. Plus, you're getting that tax deduction every year. It's above the line deduction. So it lowers your adjusted gross income, actually lowers your modified adjusted gross income too. And you save on the payroll tax. So there's a lot of tax
benefits. Yeah. If you guys want to get Justin excited, ask him about HSAs, man, and get going. So
the other
some reason my other screen froze, so I can't verify it, but you and I both would put our money on age 65, I think, on the HSA.
With an FSA, it's use it or lose it. So this is different than the HSA, but with the FSA, it's use it or lose it, except for you can roll over $640 to the next year.
Yeah,
so
good to know.
If you have an FSA, you need to make sure that you're using it or at least getting it below that $640 threshold before year end. And there's some spas where you might be able to go get a massage, or a chiropractor, and you could possibly use that FSA. So.
Now you got our attention here. We can get more tax-free massages. That's what it's all about. That's the takeaway today. That's great. Want to mention the donor advised fund for giving. I personally use it. A lot of clients use it. It's a way you can give anonymously, systematically, super simplified tax prep. Because if you do all your giving through a DAF, all you need to know for your tax return is how much money you put in the DAF, the donor advised fund. Really great thing. You can give appreciated securities. So most of our clients that have non-qualified appreciated stock, we say, hey, stop giving cash. Start giving appreciated securities. You put the appreciated security in the DAF, it sells it. It's technically a 501c3, doesn't pay any gain. So less money, Uncle Sam, more money for nonprofit work. We're big fans there.
And consider bunching as well.
Right.
So it's a strategy where you pre-fund the next year's worth of giving. So if you have a set amount that you want to give every year, there could be some tax advantage for you to pre-fund the following year's giving and put it in that donor advised fund this year, and then take the standard deduction next year. So talk to your advisor about that. But for a lot of folks, there's value in bunching if you can. Not everybody is in a situation where they can, or in a situation necessarily where they would benefit from it, but a lot of people do. So,
yeah, I think it's worth learning about. All right, let's land the plane here. We've got two last things I'd love for us to talk about. The SALT workaround, the pass-through entity workaround. You want to explain that one, Justin?
Yeah. So this is for anybody that's a business owner of a pass-through business entity, you can have your business pay your state taxes instead of you paying them personally. And the advantage when your business pays the tax is that now it's fully deductible instead of only $10,000 being deductible. So under the current tax code on your personal tax return, you can only deduct $10,000 worth of state and local tax. However, if your business pays it, it becomes fully deductible, saving you a good bit of money. So let your business pay your state tax.
Yeah, absolutely. I love it. That's something I implement personally with my businesses, and it's got an economic benefit. It benefits all owners, even if you're not the only owner. It kind of goes through pro rata to the K1, so it can be a really, really great strategy. Last thing here is if we've got Georgia listeners about maybe the Georgia Heart Program, you can certainly look into your state as well, but it's basically a way that you can redirect your state income tax dollars maybe towards something that you've got a little more control over. You want to explain that, Justin?
Yeah, it's just like the SALT cap workaround. I mean, it functions the same way, but you redirect your state tax dollars to go to a local hospital, or there's Georgia Goal, which is basically the same as Georgia Heart, except for instead of your money going to a hospital, it goes to a school. And so it's a great opportunity to be intentional about where your state tax money goes. But there is an economic benefit for pass-through business owners who, again, redirect their state tax liability through their business and donate that tax liability. If you owe $20,000 in state taxes, you make a $20,000 donation to a hospital or a school through Georgia Goal, one or the other, and that reduces your federal taxable income. So it's a great way to save money and be intentional about where your state tax dollars go.
Yes, sir. Well, hey, if you're still with us, I'm super impressed. That was a lot that we jam-packed in. I think it would be super helpful. Hopefully it is. If you want more, again, we only covered half of the bullet points in our guide, our year-end planning checklist. So check the show notes, check our website, and download that for help. Wanted to thank Angela Lyle, our producer, and Tara Bruce, our content creator. And before we sign off, Justin, I just love ending with gratitude. It is Christmas time. So as you're thinking of something to share that you're grateful for, I will just share that I really love lights. I love people hang up lights, and it's all over the place, in our little downtown areas, in our neighborhoods, driving around. I love seeing even on the social media platforms where people just go nuts, syncing it up to music and fireworks and flames. I definitely love when all the lights start coming out. We've started to add a little bit more at our house, but my wife kind of has that rein me in, so I'm not pulling off like a Chevy Chase Christmas vacation, shut down the nuclear power plant kind of situation. But it's tasteful. I can say it's tasteful. What about you, bud?
And so I love seeing people put up all the Christmas lights. I mean, it makes me happy, but I personally don't enjoy putting them up myself. So.
Yeah, got to figure out an easier way to do it, right?
Yeah.
Like at what was it like on Dr. Not well, it's Dr. The Grinch, right? Where she's got the gun and she's just shooting them on to the the side of the roof. Boom, 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 boom. That's what we need. That's what the outdoor
Oh yeah. That'd be awesome.
Hunter and fisherman needs is a gun that can hang up lights, just shoots them out of the roof, right? Oh my gosh.
Awesome.
Yeah. So, well, hey, we really appreciate you joining us. I hope you feel better, and thanks for sharing all your wisdom today on the Money Pig.
Enjoyed it.
All right. Take care, buddy.
Take care.
See ya. Bye.
Thank you for tuning in to the Money Pig podcast. We hope you enjoyed today's episode. To stay updated on new episodes, be sure to subscribe wherever you listen to podcasts. If you found value in today's discussion, we'd greatly appreciate it if you could leave a rating and review. If you have any questions about the topics we covered, feel free to visit us at goodwininvestment.com and reach out. This episode is produced by evance.net. This podcast is provided for informational purposes only and should not be considered as investment advice, a solicitation to buy or sell any financial products, securities, digital assets, or other investment vehicles, nor as a basis for making any financial decisions. Goodwin Investment Advisory is a registered investment advisor with the SEC, CRD number 131193. Please note that the host and or guests may personally own securities, digital assets, or other investments mentioned in this podcast. Investments carry risk and are not guaranteed unless stated otherwise. We strongly recommend consulting with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategies discussed in this episode. Lastly, past performance is not indicative of future results.